today's ride, I wanted to talk about owners of S corporations or partners in partnerships and the issue of compensation. One of the questions that I get a lot from partners in partnerships, owners of S corporations, is form of compensation. For those that participate in these, you might know, and if you don't know, there's actually two different ways that you can receive compensation from your company. The first is either salaries or wages if you're part of a corporation, but then if you're a part of a partnership, instead of actual salary or wages, you get what's called a guaranteed payment, which is like a salary. The only difference is that with a guaranteed payment, no taxes are withheld. You, as the partner, are responsible for paying all the taxes on any payments that you get out from your partnership. So that's one way. The other way is through distributions, which are a way to take your profits out of the company. There's actually two different tax treatments between how you receive this compensation. So I often get asked, which one should I do? Should I pull it out as wages or guaranteed payments, or should I just take a distribution? What I wanted to break down was the differences between the two to help you decide which direction that you want to go in. There's three different things that you have to consider when deciding how to classify it. The first is the salary or the wages or guaranteed payments. If you were to take the funds out as that does count as a deduction against the company's taxable income. So the good news is it does count as an expense for the company's taxable income. The company's net income is reduced by what you're paid out. Now, if you have multiple owners or partners, it's a good way to ensure that the owner or the recipient of those payments pay their fair share. They pay their own because those funds were specifically allocated to them, and that person would be then responsible for paying their taxes on those wages on their personal returns. So that's the effect on one. However, if you take that same compensation and treat it as a distribution, it is not a deduction against the net income. So let's say that there are four partners. One partner takes $50,000. That partnership income is not reduced by that $50,000. As a partnership, you pay the taxes on the profits in proportion to the ownership. So going back to our example, if there are four partners, one partner takes $50,000, and assuming everyone owns an equal share, each partner would then technically have to pay taxes on 1/4 of that $50,000, even though that actual $50,000 was distributed to just one person. So that is one thing that you have to keep in mind. In most partnerships, obviously there's variations, but I see a lot of partnerships structured where usually if you're taking distributions, everyone's taking pretty much the same thing. But that is one thing that you have to consider, the tax implications of that. The other thing is you also have to consider is cash flow. So going back to the example that I just gave about the partners now having to pay a quarter of that $50,000, they obviously need to be compensated. They would need to have the cash to be able to cover the taxes because they're being taxed on money they never received. So the company would now need to pay out or distribute cash at least to those other three partners so that they can cover their tax liability. So if partner A takes out $50,000 as a distribution, the partnership still needs to be able to have enough cash on hand to dole out to the rest of the partners so that they can actually cover the tax bill on their share. But if that distribution was instead classified as a guaranteed payment or a salary, the partner who took that cash would then be responsible for paying the taxes on their own. And the third issue is, without getting too technical, something called basis. But you can think of it as like a running tab to show how much you have in the business. It's your running count of your share of the business. Every time you make money, your basis goes up. Every time you lose money, your basis goes down. And anytime you take a distribution, your basis goes down. Now, with basis, your basis cannot be negative. It gives you a tab on how much you own of the company. So you can't have negative ownership in the company. So you always want to have a positive basis. But when you have distributions, that brings your basis down and you can't go below zero. And why basis is important is because, let's say that you get to the point where you or any other partner or shareholder, they want to cash out. They say, look, I'm done, I'm out, and they want to leave for whatever reason, or they want to be bought out or cashed out. A lot of those calculations are based upon your basis. If you, throughout the years, took a lot of compensation as distributions versus your salary or guaranteed payment, and if your basis gets to a certain level or a certain point, you don't technically have that much ownership left in the company. So if you got to the point where you wanted to cash out and you took a lot of distributions, your buyout actually wouldn't really be that high because you've extracted your value from that corporation or partnership over the course of the years. So that is another thing that you have to consider. Quick tidbit of what I do with my partnerships and corporation clients to try to keep it as clean as possible. What I usually advise is I save distributions to cover taxes. If you want to decide to pay out salaries or someone wants compensation for themselves, we usually try to create it as salary and usually reserve distributions for covering the taxes on the profits. So that's it for now. Feel free to reach out if there's any additional questions on the matter. Talk to you soon.